Great. So here are our disclosures. Just need to run through this really, really quickly, and then we'll get to the fun bits, guys. This presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussions of a particular market or product should not be construed as an offer to sell or a solicitation of an offer to buy in any financial market whatsoever. The presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we do not guarantee or verify the accuracy of the information or commentary provided. It will include references to actual past trading results for discussion purposes. Past results are not necessarily indicative of future results, and increasing your leverage also increases your risk. Any references to historical price movements or levels are informational based on our analysis. Just one last thing as well. Futures, options on futures, foreign exchange and other leverage products, they involve substantial risk of loss and they're not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act. Contracts for difference, that's CFDs to all you guys, they're not available for US residents due to regulatory reasons. Okay, guys, I think that's just about enough of that. Just bear with me one moment. Yeah. So let me just pull up my chart now. Great. So here we go. This is actually CAD yen. I'm not going to start with CAD yen though. Bear with me one moment. I'm actually going to start with cable. So we've seen quite some interesting goings on in cable. As you can see, this is just the hourly chart. Had nice recovery from that dip below 155 yesterday, but really 155, sorry, at the end of last week. But really above 153.50, we just haven't made any traction. And I think there's a big reason for that. Just bear with me one moment. I'll just pull up another chart. One of my favorites. You know, we are running up against a massive level of resistance. As you can see, this is cable. There's that nice recovery I spoke about. But yeah, we have not been able to make traction above the top of the daily cloud. So that comes in at 153.42. That is the top of the daily Ichimoku cloud. For those of you that don't use Ichimoku, maybe don't even know what it is. It's just it's like a technical strategy, really, and a way of looking at the market. So the clouds, they're a derivative of kind of moving averages, such like. And the basic thing, now you can do some reading up about this on your own time in Wikipedia or whatever else, but the basic concept of the Ichimoku is that anything above the cloud is considered an uptrend, and anything below the cloud is a downtrend. Anything within the cloud, we're not trending. So right now we're at the very top. We're kind of pushing towards the top of our most recent range, and getting very close to uptrend territory, but we haven't been able to push it up there. So when you get to kind of major resistance levels like this 153.40 level, in any currency cross, there are three things that can happen. You shoot above it, which suggests that the trend is very, very strong. You hover around it, which means that it's all that it's kind of moving sideways. Or you push lower and you reject it, so it suggests that it's gone too far. I wouldn't say that we're doing the latter right now. I would say that the market's really pausing for breath, because we've got some important economic data coming out later this week, which suggests to me that we're not going to get above 153.40, certainly not probably in the next kind of 24 hours anyway. I know a lot of you are kind of retail traders, and in that sense you want kind of shorter term strategies, and I think that works perfectly well for the FX market. In fact, I think it works the best. And for that reason, I think that we could see cable really struggle above here, and we have seen it today struggle. I'll go back to my other chart. I will bring this one back, don't worry. As you can see, that 153.40 to 50 level, so just above the cloud, it did peep its head above the cloud at one point yesterday. Been rejected. We even had some good economic data. We had some good construction sector PMI data, for those of you who follow the fundamentals. Basically, it was just some economic data on the or economic data on the construction sector in the UK, which is obviously quite important, and it was better than expected. But but not so good that it caused us to break above the top of that cloud like I showed you. And instead we've just backed off here. We're currently below 153. Now what those of you who traded yesterday, who did trade yesterday actually, or even watched the markets, you'll have seen it was a fascinating day. We had a nice especially for the dollar pretty much, we had a kind of a move higher and then a move lower. We saw some real volatility in the markets yesterday, but we are hearing there's a lot of some illiquid conditions this week, and that's no wonder, because this week is a very important week. It's non-farm payrolls week in the US. That's a massive US labour market data. If you read anything about fundamental analysis, that's the key statistic globally for the FX market, but for a lot of other markets as well. And we think the markets are just trading sideways really just till they get that data, because when you're waiting for something that's really important that could really determine future events like future monetary policy, etc., investors aren't going to take this lightly. They're not going to kind of try and second guess what the payrolls are doing. Instead, they're going to want to see the data, digest the data, and then make their move. And that's the reason why people are they're profit taking basically. They're profit taking at these levels here in cable, because they don't really know what the future will hold. Now that's also been fairly similar. Let's take a look at dollar yen. That was a big movie yesterday as well. We've seen dollar yen, sorry, my chart was just uploading there. Saw dollar yen sell off so sharply. Let's take a look at this daily chart first. That was like the daily move. Now we got below 100. Remember that key 100 level? We shot below there, but since then we actually got below, got all the way down. Let's just take a look at the very, very short term chart here. Take a look at a 2-day chart just to show you this story. So this is it, dollar yen really trading in a range. Then we get some very weak economic data out of the US. As I mentioned, the NFPs is the key release, but we have got some other important releases this week, like the non-manufacturing ISM report, or the manufacturing ISM report, yesterday, which was really weak, much weaker than expected, in stark contrast actually to the UK. And there we saw dollar yen just fall like a stone pretty much. We got all the way below 99 at one point before bouncing back. Now what we think happened is that the market got a bit overextended. As it tends to do, the market does tend to overshoot, and since then we've been able to kind of recover some of our losses, but we're not quite there yet. We haven't recouped all of the losses. Instead what we're doing, we're just running into a little bit of resistance there at 150. So the range right now looks probably about a 50 pip range really for today. We've got some trade data coming out for the US later, which could just help us get back above that 150 level if it's positive for the US. But until then, there isn't really too much fundamental drivers. Remember, technicals are very important. Fundamentals can sometimes drive the direction of the market. So while we're not seeing that, we are we could potentially kind of just move sideways. So we've had, the sharp move lower on this is manufacturing data. The market thought, oh no, we're a little bit overstretched, and so it's recovered. Now, there was another reason why it's recovered as well. This is the daily chart. As you can see, this green line here is the 55-day moving average. That comes in at just around about 98.70-ish. So when we dipped below 99, there was always going to be a nice level of support just to help support us, and just for the recovery to bounce from, if you like. But as you can see here, still momentum still to the downside really. We have been hearing a bit of chatter from the banks that there was very low liquidity below 100, hence why we saw that very sharp drop all the way to below 99 at one point. So that what does that suggest, and how do you really interpret those little bit of tidbits of information that you get from banks that you sometimes see on Twitter and everything else? Well, usually I think if it suggests that there's not much liquidity below 100, I think it suggests that there's not too much activity down there. That really, what it suggests to me is that people will buy on the dip then, and that people are still looking for dollar yen to go higher. And what you tend to see if there's, if we make a break, say a break below a key level like 100, if that's going to be the start of a more prolonged downtrend, then I think what you tend to do is, really, fall quite sharply and you see a lot of interest, you see a lot of liquidity building to the downside. When you don't get that, it suggests to me that maybe there's not too much demand to push it any lower. Instead, people are just waiting to buy at better levels. That's kind of what it suggests to me, but it also suggests that maybe people are staying out of the market. They didn't like the volatility, and they may just be waiting for the payrolls number. So the payrolls is a monthly data release, but it is going to be very important. It's real data that the Federal Reserve look at very, very closely. If they're going to be, ending their QE3 program, then that's going to be very important. So as you can see, dollar yen. I'll also show you something else. This is just shows you just how important this kind of this 98, 60 to 80 level is. As you can see, it's channel support, but it's also that 55-day moving average. So really, really important level, and a very strong support level that's held. So even though we did have a sharp move lower in dollar yen yesterday, we certainly haven't broken any new ground. We're still range trading. Now, I also want to show you something. I want to show you two things, really. Just bear with me. I'm just pulling them up on my other chart package, which can be a bit slow. Forgive this. Okay, here we go. So a lot of people have been talking about, drivers of dollar yen. Drivers of dollar yen used to be, those of you who trade FX will know that, yield has a strong relationship with currencies. And it used to be kind of government bond yields that drove this cross. However, of late, it hasn't been that. What this shows you, the white line is the Nikkei, so the Japanese stock market, and the orange line is dollar yen. And as you can see, a really close relationship. They've always had a fairly close relationship, but just at the same time that the Nikkei has come off, the dollar yen hasn't been close behind, hasn't been far behind. And basically, the Nikkei sells off. That tends to be a yen positive, because remember, the yen acts as a bit of a safe haven. What we've seen here, this is quite a sharp move lower in the Nikkei. That's more than 15%, and that's just since the 21st of May. We've had some volatile moves in the Nikkei, and that fuels demand to buy yen, which has helped take the edge off dollar yen. So taking that level below, or taking that cross all the way to below 100 at one point. So what we've seen is that when the Nikkei sells off, the yen rises, dollar yen falls. When the Nikkei recovers, like it did today, dollar yen makes a recovery like it did today. So that relationship is holding at the moment. And what is quite significant as well, I'm just going to shift onto the full Nikkei here. Just bear with me one moment. This is a Fibonacci retracement chart, and what I wanted to show you here is that we really did bounce off some nice, or managed to hold above some, really good support here. The 61.8, or it's actually the 38.2% retracement from that high that we reached earlier this month. So we're holding at some very good fib level support here, even though we did get below the 50-day moving average. But 13,000 is a massive level. We're currently trading 13,533. I know these sound like enormous figures, but it's actually largely the way that the Nikkei index is compiled, that it just has these very large numbers. So 13,000 a key level, that's a key fib level in the Nikkei, and as you can see, it held really nicely there. So that's kind of helped fuel that recovery. Those of you, I don't know how many of you are that new to technical analysis, but what we've really seen, Fibonacci, these big Fibonacci numbers do tend to be respected by the market, so they do tend to hold. Apologies for those of you who are masters of the Fibonacci retracement. I'm trying to balance it out here. I get a good balance between everyone. So what we've seen is that's held, and then if I just go back to my chart, as you can see, that's also that's kind of fueled this bit of a recovery, both in the Nikkei and also in dollar yen, of course. Now, I also wanted to just run through euro dollar with you, because I'm interested in euro dollar, and believe it or not, I'm interested in it to the upside in the short term. So whereas for the pound, I'm interested in a more shorter term outlook. I think there's the potential for it to go lower because of that massive resistance level. I don't think that the bears are out there. I think we've also get, you know, any move towards kind of 153.40 to 70 could potentially be sold into. With the euro, I'm looking at it from the other side. I think there's the potential for it to actually recover. Not a huge amount, absolutely not, but I think to recover back to maybe the top of its range. It's currently trading at 131. Now, we do have an ECB meeting later this week. They're not expected to do anything. Now, I think if they kind of maybe dismiss the idea of negative deposit rates, now come back to our website for its com tomorrow. I'll send you actually a link to our research, but I'm going to put something out. I'm going to put something out about the ECB meeting tomorrow, so do watch out for that, and I will kind of explain everything to you. But I do think there's a potential we could get above 131, potentially get up to 131.50 if they don't mention negative deposit rates. And I think it's a very short-term chart. I think it could be quite volatile, yes, but I think if you kind of have a strategy that's quite short-term, that's looking at, in and out very, very quickly, I think that could be a fairly, or I think that could potentially be quite good. Let's take a look at it just from a. So as you can see here, we're pushing close to the highest level we've been in 10 days. Obviously, the euro has been under some pressure then. 131 is a key level of resistance, but I do think that if we get above there, then it could open the way for a return to these kind of 132 highs, which we saw at the end of April, beginning of this month. And I think that we could potentially be, or the potential driver of that could actually be the ECB meeting and them not mentioning these negative deposit rates. Now, I think at 132, I don't think we're going to extend gains from there. Remember, the growth prospect is quite weak. I also think, you've got to remember, people are going to be booking profits ahead of the non-farm payroll report. I think it would take a very, very weak NFP number to get us above 132. So I'd wait for that, but I think just as a short-term ECB market idea, I think the euro, there's the potential for the euro to go higher. Obviously, though, the caveat is if they turn around and say, well, no, actually, we love the idea of negative deposit rates, or if they cut rates there and then euro could be, down well below the bottom of its most recent range, below 128, in very, very short concession. Now, Pan has just said, Yaz has asked me to look at the Aussie. You like the Aussie, Yaz, and I will look at it just after this. Pan's just asked me, is euro negatively correlated to sterling Swissy? Interestingly enough, when you say that, is it negatively correlated to sterling Swissy? I think what you need to look at is euro Swissy and sterling Swissy, because what you're looking at there are the crosses, basically. Because obviously euro Swissy, let's take a look at that. So this is euro Swissy, and then I'm going to pull up another chart, make it a bit smaller, and I'm going to do sterling Swissy. In fact, I could put them both together, actually. That's probably a better idea. Just call them Swissy crosses. So there you go. Just made myself a new chart. As you can see here, negatively correlated. I mean, there's a bit of a negative correlation there, but I don't think it's actually not very strong. As you can see, they kind of peak together. So we had a peak in sterling Swissy there. We had a peak in euro Swissy there. There's a bit of a lag between them, but as you can see, low in euro Swissy, low in sterling Swissy. There was a bit of a negative correlation there, but I really don't think it's strong enough. You can tell that just from looking at it, to kind of potentially so okay, Pan, right. So what's Swissy, just the one thing always to remember with any of the Swissy crosses is that they tend to be very sensitive to risk. So the Swissy crosses would be negatively correlated to, I suppose, risk aversion. So when risk is high, the Euro Swiss and Sterling Swiss will fall, as we've seen, like the last few sessions. And when risk sentiment drops, then the Swissy crosses will drop, because obviously there's a lot of safe haven inflow into the Swiss franc, and likewise when it's vice versa. But really, sometimes you're long on sterling Swissy at the moment. Yeah, I don't think that's a bad shout. If you expect the markets to be fairly calm, I would say that's a short-term chart, but do be careful. A short-term idea, but do be careful with any of the Swissy crosses in case we get some very negative number out of the NFPs later. I think maybe one of the reasons why you're looking at sterling Swissy is because of relative monetary policy stances, because you do have a Bank of England meeting later. I think that's quite a good. I think, you know, on that basis, I think that's a very, very good basis. But you've got to also remember that the Swissy is a safe haven. Now, as you can see here, oh no, sorry, that's the wrong one. So as you can see, if cable makes a bit of a recovery, then so should sterling Swissy as well, because this will be a lot of this is quite a illiquid cross. So as you can see here, yeah, looks like we've made a nice bottom there at 144.80, which is the bottom there. And as you can see there, top of the recent range is 146.99, so just below 147. So we are a little bit range bound at the moment, fairly tight range going on. Ray, thank you for your very sweet message. That is very nice. I did recently write a book, and it's called Kathleen Brooks on Forex, if any of you are interested. But thank you very much. It's just a very simple kind of guide that just shows, you know, the fundamental side that I look at, the technical side that I look at, how I organise the information. I felt that there was a real gap there for doing that, because there's an awful lot of information, and as I try to in these emails, I try to do kind of two objectives really: tell you the fundamental backdrop, the context for the market moves, and then some of the technical factors as well. But I love getting your ideas. I love looking at what you're looking at the moment. Pan, if you just want to drop me a quick line on why maybe you're looking at sterling Swissy and why you think it's going to move higher, that would be quite interesting. If it's purely technical based on the bounce from the 50-day moving average, or if it's maybe there's a fundamental factor in there as well, do let me know. Obviously it hadn't fallen to the bottom of its most recent range, of its monthly range, but it had, so it's purely technical. Is it based on that 50-day moving average maybe? It could well be. We've also got a bit of a nice bit of a reversal pattern there, but I would say, you know, keep your outlook quite short, largely because, you know, we do have that, you know, a potential massive risk event coming up later this week. So, you know, if we do get back to that 147 level, I mean, that's quite away from where we are now, then do watch out for that. I mean, added to that as well, when you're trading these kind of more liquid sterling crosses, do watch out what's going on with cable, because the reason why sterling Swissy is not moving, we've got quite a low volatility environment at the moment. I mean, my preference right now would be probably to ditch the crosses and just look at the major pairs. Because volatility is quite low. There's a great chance it's going to pick up later though, so maybe maybe this is a good kind of, you know, hold the trade and wait type of thing. But do be careful with the long sterling Swissy position later this week, because of those risk events that I mentioned. This cross could go you know, kind of crazy. As you can see, you know, this was the big move lower that we saw at the end of last week, when we saw a lot of risk aversion in the markets. Likewise yesterday, you know, the ranges have actually narrowed quite a lot. As you can see, I mean, the open close ranges, obviously the daily range there was quite wide. I wouldn't be surprised if we traded sideways a little bit from here on in. But Yaz has waited very, very patiently, and I'm going to talk about Aussie. So this has been the story of Aussie today. Aussie has backed away from those 98 highs, which is now, we think, a bit of a short-term top. The reason for it was fundamental. It was the RBA. They met today. They came out. They didn't do anything, but they sound a little bit concerned about Aussie dollar strength. They also definitely kept the door open to more rate cuts. So what we saw was a nice decline. A very sharp decline, actually, got all the way back below 97, but we have held fairly good support here at 96.5. So for us, we're in range trading mode in the Aussie at the moment, with 98 or just below 98 being a nice, being a top, and then the low coming in around about that 95.80 level, which is a 12-month low. So we did get below there at one point last week, but we think that was a bit of a false break lower. So instead we think, you know, we're kind of trading the range. I mean, obviously when you're getting big sharp moves like we saw earlier today, then we would expect them to give back some, but the closer we get to 97.50 than 97.70, then I think we'd look for short positions for the reason why is that we think the short-term top is 98 and we don't see anything pushing us one way or the other. Now, if anything, we think that there is the GDP report coming out of Australia tomorrow. That's expected to show a bit more of a softer tone to GDP data, even though it is expected to be positive for the first quarter. And again, that could just weigh on just if there's any type of data miss tomorrow. I think it's 2:30 a.m. our time for those of you who look at it, who are up early, and then we think that could also trigger some selling interest. Now, Rocco's asked me to look at Kiwi, and then I'm going to look at CAD. That's probably going to be all I'm going to have time for. But these nice commodity crosses, they've really been pretty volatile actually, but overall they're trading in a range. So for Kiwi, for example, 79.50 on the upside, and yet 81 is really, or just above 81, was really taking out the bulls. So there you go. That's our range for the Kiwi. It is a commodity currency. It's not been as battered as the Aussie, but obviously this payrolls report is going to be massive for it. If we get a disappointment and we see the the US dollar sell off, then the Kiwi dollar could recover above 81. There's 81.30, and then there's 82.05, massive resistance level. And then on the downside, obviously 79.50, we think will hold certainly in the short term. Now let's take a look at that CAD. CAD again been very volatile, but it is a commodity currency. So if we do see a recovery, which we don't necessarily think we will, might get bouts of recovery, then that should be quite good news for some of the commodity currencies. And we do think that 95.80, 79.50, potentially kind of 102.50, this kind of 103 level, or 103.60 to 70 level, is in dollar CAD. They're kind of, the lows for these commodity currencies right now. As you can see, dollar CAD, sharp move lower yesterday. The CAD was strengthening here, and then since then, like everything, the dollar's made up some ground, but it is running into this congestion zone around 103.30, and in terms of what else are we looking for? For us, this cross is all going to be dependent on what goes on with payroll. So I'm a bit agnostic at the moment with CAD. I don't see it really going anywhere. It's very choppy for me. I'm keeping it at arm's length. I think it will move overall with commodity currencies. I prefer the Aussie, if I'm honest. Obviously, dollar CAD can move very violently on the back of payrolls. A strong payrolls number, remember, could actually be limited gains in dollar CAD, because that's good news for the Canadian economy as well. What am I expecting for NFP? Well, the Bloomberg expectation, which is market participants, is looking for 165,000 for May, so 165,000 increase. Three things to watch out for. The overall payrolls number, private sector payrolls, we'll get a first glimpse of that with the ADP on Wednesday. And then lastly, what we're also looking for is the unemployment rate. Remember, that is what the Fed is targeting. That's expected to be 7.5%. We're probably going to need an increase of about 200,000 plus to bring that employment rate down. Remember, the Fed is targeting 6.5%, so we're still some way from there. Also, watch out for any revisions to prior months. They have been absolutely huge. In fact, last month it was the massive upward revision which actually caused the big move higher in the dollar. So that was the key thing. Now, I could really talk to you guys for days and for hours on end, but I'd bore you to death, no doubt. Thank you so much for joining and for having such great questions. Thank you all for your kind words about the book as well, Russ. And please do join us next week for more. So enjoy your week. I'm actually not going to be here for payrolls. I've got a couple of days off at the end of this week, but I will certainly be looking for it eagerly from where I am. So thank you very much. And good luck trading this week, guys. Thank you.